When should you start investing? And which investments do you need to do in your different ages? Investments you can do in your 20s, investments you can do in your 30s, investments you can do in your 40s, investments you can do in your 50s. I'm going to talk about all those in this particular video because it is important for you to understand investing and also understand the best investments you can do in your specific age bracket. That's why I'm making this comprehensive video. So watch the whole of this video because what I'm going to be sharing is essential to you. It is knowledge you can share with your sibling. It is knowledge you can share with your children so that all of us can collectively invest and work towards becoming financially free. You are all much welcome to this video. My name is Afagza Sifunam. In case you are new here, down there is a button called subscribe. Kindly consider subscribing to this channel because each and every day I'm out here bringing you amazing videos on matters money, investing, you name it. Subscribe to join this channel so that you don't miss out on any of my videos. And while you still at it, drop a like on this video. Thank you for subscribing and also dropping a like on this video. To cut the chase, the best time to invest is now, regardless of your age. Whether you are 20 years old, 25, 39, 45, 54, the best time to invest is now. And I'm saying so because in this entire life, there is no stopping when it comes to investing. And the amazing thing about investing is that the early entrants are the ones who benefit from entering any particular investment early because there's huge benefits to that. And secondly, time horizon is key to investing. Let me give you an example. If, for example, you have two people who maybe did work at the same time, okay? One began investing at the age of 20, another one began investing at the age of 40. Regardless what a person at the age of 40 does, if they delayed investing by 20 years, due to the benefits of compounding, okay? Due to the benefits of using techniques like dollar cost averaging, where maybe someone puts down a specific amount of money every month or even every year, the person who begins investing in their 40s will rarely catch up with someone who began in their 20s. That is why the best time to invest is now, so that you can have a good chunk of time horizon for you to realize the benefits of your investments. Having said that, have you begun investing? When did you begin investing? Drop a comment down below in the comment section. And is it true that you starting investing now is the most important thing you can do? Please comment down below so that we can be able to learn from each other. Those who began investing early, how is it taking you? In case you are beginning now, do you wish you began earlier? Comment down below in the comment section. With all that said, let's look at the rational investment for people in different age groups. For a person in their 20s, they are at an interesting stage where they can take risks, okay? And also the time horizon is very big, okay? So with that, some of the best investments are, for example, block index funds and also exchange traded funds or ETFs. Why am I picking this as the first best investment for the person in their 20s? I'll pick this because this investment typically reward investors best in a long time horizon. Given a person in their 20s has a long time horizon to retirement, them jumping on this is going to ensure they maximize their returns in their lifetime, as opposed to them, for example, jumping or chasing quick emotions in the market. Chasing emotions in the market is only going to make you even anxious. And I fully understand. In your 20s, you can take risks. That's why also these are going to be part of your portfolio. But thinking about block index funds or even ETFs can really assist you skyrocket your investment over time. Okay? And the second best investment for someone in their 20s is investing in pension or retirement accounts. Guys, this is an interesting money hack. If you are young, you investing in your pension or retirement account really goes a long way to ensure you maximize your financials in your lifetime. And this is an amazing hack because rarely do these accounts attract tax. In most economies out there, these accounts are tax-free, okay? And even for those economies which maybe do tax, the tax is completely minimal or very low compared, for example, pay as you earn and other forms of taxes out there in case you direct your money towards those alternative investments or even accounts. That is why you need to capitalize on retirement accounts and pension accounts for you to be able to really realize the benefit of you channeling your money to those accounts, because at the end of it, come retirement, you're going to be able to enjoy both interests, which you're going to be maybe sharing with your insurance, and also the tax-free nature of these accounts. Okay? And then the third investment for a person in their 20s is high growth individual stocks. Please understand that this one, you need to keep it modest. And I'm assuming you are building a portfolio. So these high growth stocks have the potential to really reward you because of two things: the potential for upside on capital appreciation, okay? And also the potential for dividends. Let me break it down for you. In case you are investing your money in the stock market, you can only make money in two ways, okay? Through either capital or share appreciation, and you making money through dividends. So jump in early, but keep it modest, so as not to really go in that particular tirade of you being anxious, you being worried because you put all your monies in the stock market and the stock market is really fluctuating. That's why you need to balance, okay? Through the block index funds, balance through retirement accounts, and also those high growth stocks, which you balance between the new or growing companies and also mature companies, okay? Because the new and growing companies are going to give you share appreciation, and the mature companies are going to give you dividends because they have a history of paying dividends year in, year out. And then the fourth and last area a person in their 20s needs to invest in is investing in their education or skills. It is interesting how the world, whether through formal employment or even informal employment, does reward people based on their ability to do problem solving. Basically, you are paid because you can solve a problem. And that is why in your 20, invest heavily in education and skills for you to be able to increase your propensity to solve problems. Now let's talk about the investment you can do in your 30s, okay? 30s are a critical age. And I'm saying so because these are the age when you need to be balancing growth, family responsibilities, savings, and also your ability to grow wealth. And that is why in your 30s, among the best investments you can do is you investing in your equities and index and balancing, utilizing portfolio to ensure you don't put all your eggs in one bucket. Reason being, you are balancing responsibilities, you are balancing growth while also thinking more actively about your retirement. So put your money on index and also equities, but most importantly, ensure you are building a portfolio. Don't just risk by putting your monies in one stock or even one bond investment out there. Balancing is essential because you are getting at a phase where you need to start actively mitigating risk while also thinking about continuing to grow exponentially. That is why equities are very key in your 30s, okay? And then the second one is investing in a first home and income generating estate. What do I mean? Remember, I've said in your 30s is when you are at a phase of growth and also realizing stability in the same equation. So investing in your first home or your first stable real estate property is essential in your 30s. Whether it is land, whether it is commercial properties, you name it. This is going to assist you trigger rental income and also feel the safety of having a home, okay? And the third one is bonds and money market funds. Beyond just investing in high risk equities, think about, and by that I mean shares or stock, think about also investing in bonds and even money market funds. Why are these important? Bonds are going to assist you also capitalize on coupon interest, which typically has quite a longer time horizon than just shares. Think about even, for example, treasury bonds, government bonds, which are tied to given infrastructure, and you're going to be able to make money with less default risk over time. And that also goes for MMFs, the money market funds. You can utilize MMFs as your liquidity buffer, where you push some of your money to MMFs to assist you with building your emergency fund, and even as a parking lot of where you can hold your money as you are thinking or even scouting for the next best opportunity. That's why MMFs are also powerful. And then the fourth area is you investing in your children's education. I'm assuming in your 30s, you're probably growing a family, right? Whether it is your immediate family or even responsibilities you've assumed around other young adults within your larger family. So think about investing in the children's in education, because education is the best equalizer when it comes to building wealth. You don't need to be saying, for example, I'm actively saving in my current account for education. There are different education solutions out there offered by banks, offered by insurance companies, and all these typically have an interest which you can be gaining each and every year, because when you push your money there, your money is going to be used towards those investments which are low risk. And also, you're going to enjoy the interest which comes with having such a kind of account. So automate your cash flows to an education account for your children or even other young adults you have responsibility for, and see how these are going to assist you grow your wealth and also reduce your risk. And then the last investment you can do in your 30s is triggering cash flows. Cash is king. And that's even said for a reason. Because even if you have very huge investments out there, but they are illiquid, when you need cash and you can't obtain it, you'll really be stressed. That's why you need to invest in investments which can assist you get cash. Business. Businesses are a key thing which can assist you get cash when you need cash. That's why in your 30s, think about having at least one business. And if that momentum is working with you, even expand, have multiple businesses. Because beyond investing in the stock market, investing in bonds, investing in even you, for example, having MMS, also having a business is essential, because that is what is going to be driving profitability, enabling you have cash flows. And remember, cash is king when it's all said and done. Okay? Now, let's talk about investments you can do in your 40s, right? In your 40s, the most important thing is portfolio balancing and preparing for retirement. This is really a very important thing in your 40s, because in most jurisdictions out there, people retire in their 50s. So in your 40s, you need to gain stage for this retirement quite early. That is why at the center of the best investment you can do in your 40s is having an optimal portfolio. What do I mean? A portfolio is basically where you have or you invest in different types of assets or investments with the aim of reducing your risk while also ensuring you are getting a return. In your 40s, ensure you are building a robust portfolio, or even you are doing balancing to ensure the portfolio you have works for you. In that, you are balancing growth while also minimizing risk. Because you are at a phase where you can't put all your eggs in one bucket. That's extremely risky. You need to be doing risk reduction in your portfolio. That is why in your 40s, you building a portfolio and also diversifying is very important. And in your 40s, also, the second investment you need to jump on and prioritize is quality dividend stocks. What do I mean? Please note, I haven't said you need to focus on shares. You need to focus on high growth investments. Yes, in the stock market, you have high growth companies and also you have mature companies. In your 40s, focus on quality, high dividend stocks. With that, I mean, it is better to put your money or reconstitute your portfolio to have a good chunk of mature companies which are paying dividends year in, year out, instead of you chasing market sentiment and hoping for share appreciation. Yes, there's an upside in new companies because they can grow extremely rapidly. But then again, in your 40s, I think you need to be minimizing on that and focusing more on stability. So look at building portfolio which has more of mature companies. The companies annually give you dividends, which you can plan for in a much better way. Okay. And then also focus on bonds and fixed income securities. Why bonds and fixed income securities? These are key because bonds and fixed income securities ensure you enjoy what is called capital preservation. Basically put, your initial investment is at much less risk. That is why in your 40s, you, for example, capitalizing a lot on government bonds, like for example, treasury bonds, and also fixed income securities is going to really assist you preserve your capital, because capital preservation is very, very important in your 40s, as you are not in a space where you are looking to lose lots of your investment. Okay. And then in your 40s is also where you need to be expanding on your real estate, whether it is the physical real estate investment or even real estate investment trusts, REITs. Because in the real estate space, you can invest in the physical real estate or even virtual real estate, where you give companies out there your capital. These companies plow the monies into actual real estate investments, and then you share in the returns. As they are gaining rental income, you are also partaking in that. So in your 40s, expand your real estate portfolio, because real estate typically has an upside when it comes to you realizing rental income for a good chunk of your life, because a good chunk of real estate properties out there do even have 60 years, 70 years, 80 years lifespan. And that tells you you can be able to really capitalize on these. Okay? So, last investment you can do also in your 40s, before I forget, is taking your health seriously. Out here, if you're unhealthy, there's nothing you can do. You could be out there pursuing millions of dollars, billions, but once you are unhealthy, nothing else matters. It is your health which matters. That is why in your 40s, you need to really be taking your diet seriously, taking your exercise seriously, hitting the gym seriously, so as to ensure you continue being fit, you continue being healthy. Ensure you invest in checkups so that you are healthy as you continue thinking about risk mitigation and also expounding on your investment. Okay? And then come your 50s. In your 50s, there is a huge shift. And the biggest shift in your 50s is you shifting from that high risk appetite to consolidating your security to ensuring what you have, you are securing it instead of going aggressively to grow it. That is why in your 50s, among the best investments you can do is ensuring you have low risk investments in your portfolio. What do I mean by low risk? Case in point, prioritizing things like, for example, bonds and fixed income securities. This is essential more so in your 50s, guys, because you have little room for error. Remember, your energy is dwindling, okay? Your possibilities at making money, more so in case you have little capital, is also dwindling. That's why you prioritizing capital preservation is very important, as opposed to you maybe gambling with growing companies, okay? And then the second thing is dividend stocks. Remember, I began by saying in your 40s, start really scaling up dividend stocks. Continue scaling up dividend stocks in your 50s. And that's important because dividend stocks are a key to ensuring you have regular and stable returns on your investment. Because dividends, typically, these companies you invest in, mature companies, in whichever stock exchange out there, in whichever country, are going to be paying you dividends year in, year out. Yes, they might not have their shares fluctuate a lot. Even their shares maybe in a year might not really grow. But then again, they might partake in sharing their profits with you. And that is why there is the magic. You investing in mature companies, which year in, year out, you have management and the board saying the business has been very amazing. We have a very unique competitive advantage. We made a profit and we're going to continue making a profit year in, year out. So we're sharing portion of our profit with our shareholders. That is more fulfilling because it ensures cash flows. Okay. And then the other one is annuities, and also pension enhancements where you have room. Any annuities out there are a good investment for you in your 50s. Because remember, I said you are minimizing risk. You are taking less and less risk on growth investment. So any annuities you can tap into, and even any reconfiguration of your pensions to ensure you increase any return on your pension is very important in your 50s, because you're going to be preserving your capital or your investment while also thinking about income, okay? And that is very important. And then the last investment you can do in your 50s, which I think is very important, is estate planning. The truth is that all of us as human beings, our time on this planet is limited. And that is anchored in science, which talks about lifespan in each and every jurisdiction out there. Of course, lifespan estimate varies per jurisdiction. But I strongly believe in your 50s, you need to be doing estate planning. Okay? If case you have descendants and you build a business legacy, how do you think about your legacy continuing post you? How are you mitigating, for example, issues around fighting for properties when you are gone? That is why estate planning, whether you are building a trust or whichever form of estate planning, is very important in your 50s because you are doing capital preservation, consolidating what you have, and also you planning for what next when you're talking about your legacy. That is why estate planning is very important. Guys, what do you make of this video? Are there things you've learned regarding what you can do in your 20s, 30s, 40s, and 50s for you to be able to invest optimally, to manage your risk, and most importantly, to continue growing your wealth regardless the stage you are in life? If there are, recap down below what have you learned, and also what is your age. Drop your comment down below what your age is, what you've learned, and what you wish you could have done differently in your earlier years in case you are at a different bracket when it comes to you building wealth. Cheers, guys. I've really enjoyed sharing this video with you. I look forward to share with you other amazing videos next time. Stay tuned.